Well, hello, ladies and gentlemen. Welcome to chapter one, which is city two, which is company ownership. Second video on the second topic, which is pros and cons of a company. And we're not talking about partnership or limited liability partnership or sole trader. We're just specifically looking at a company, right? Last time we spoke about different types of business entities, and this time we'll be just focusing specifically on the pros and cons of company, right? So what is the pros and the cons of having a company? So let's look at the advantage of having a company. First of all, it is easy to raise cash for a company. So it is easy to raise your capital. You can be able to accumulate a large amount of money when you have a company because you'll be selling shares. However, when you have sole trader, you may not be able to raise such amount of money. So when you have a company, you may be able to raise a lot amount of capital through issuing shares. And another good thing is that it has a separate ownership, and it has separate management. So the owners are different from managers, and these managers will be highly professional managers. They went to school to study management and they know how to manage, unlike shareholders who most of them may not be able to have management skill, right? So that is good for a business. However, the there is also the disadvantage side, which may contribute to the company. So what are the disadvantages that a company may have when it comes to its existence? Is that shareholders are most likely to pursue or want or engage to in a short-term interest because they are more concerned about getting the money now than getting the money later. Therefore, a company may be forced to do things that will only profit them in a short run but not in a long run. So that is bad for business. And it is also bad to creditors when that in a sense that when the company has its assets are exhausted, they may not be able to get the money back. They may not able to get the money because remember that the company has its own legal identity, and that owners of the company may not be held legally liable for anything. So when the company assets are exhausted, then there's nothing more to take. So it is bad for creditors when the company is falling, or maybe when the company is already failed, so they still need the money back, you see. So it is also bad to creditors, I mean to shareholders, in effect that sometimes managers may choose to pursue uh, a safe investment, and they may choose to pursue goals or perhaps projects which are not too much profitable, or which may be in contrast, or maybe in conflict with that of the shareholders, right? And also about information asymmetry, and that the manager may be hiding information such as the fall of profit, right, which may be hidden from shareholders by the manager because they don't want the managers to know that, well, we don't have profit, we have made bad profit this year. So uh, managers may hide that profit, and they may also choose to pursue a project that they think is safer, which may be in conflict of the um with that of the shareholders. And remember that last time in chapter 1 we've spoken about how to resolve this issue, but still they do exist, right? Thank you.